Every single day, the government of the United States spends nearly $3 billion on a single expense that produces no bridges, builds no military bases, funds no medical research, and creates zero jobs. It is not defense spending, social security, or infrastructure development. It is pure, compounding interest on a debt so massive that the human mind struggles to comprehend its scale. Right now, the American national debt is expanding at a rate of roughly $1 trillion every 100 days. We are witnessing the largest and fastest accumulation of debt in human history, occurring during a period of relative peace and economic growth. The question is no longer whether this dynamic is sustainable. The real question is what happens to the average family when the bill finally comes due. To understand how deep this trap goes, you have to look past the political theater in Washington and examine the mechanical reality of modern money. For decades, the global economic engine ran on cheap borrowing and cheap energy. Whenever economic friction appeared, central banks simply lowered interest rates to near zero and flooded the system with fresh capital. But when aggressive interest rate hikes were introduced to fight inflation, the fundamental math behind the nation's financial system transformed overnight. Existing short-term government bonds began rolling over at dramatically higher yields. Almost overnight, the cost of servicing the national debt jumped to surpass the entire annual U.S. defense budget. If you find these deep economic and strategic breakdowns valuable, take a quick moment to subscribe to the channel so you never miss our deep dives into the hidden forces shaping our world. This economic spiral has created a dilemma known to economists as the sovereign debt feedback loop. When a nation's borrowing costs outpace its economic growth, it must borrow even more money just to pay the interest on what it previously borrowed. It is the sovereign equivalent of using one credit card to pay off the minimum balance on another. For decades, global investors and foreign governments eagerly bought American debt because it was considered the safest asset on Earth. But as national debt levels soar past $35 trillion, international trust is quietly beginning to fragment. Major central banks across the globe are quietly diversifying their reserves away from paper currency and accumulating physical gold at rates not seen in over half a century. The consequences of this structural shift extend far beyond central banks and foreign treasuries. They hit home at the kitchen table of ordinary citizens. When a government runs perpetual multi-trillion-dollar deficits, the ultimate tax is paid not through formal legislation, but through the silent erosion of purchasing power. You feel it every time you walk into a grocery store, pay a utility bill, or try to buy a home. Housing affordability has plummeted to historic lows. Middle-class wages struggle to keep pace with basic living costs, and young families find themselves priced out of the traditional American dream. The interest trap does not just threaten national balance sheets, it quietly drains the financial security of working families. Financial historians view this moment through the lens of historical currency cycles. Throughout history, every major superpower that dominated global trade eventually reached a threshold where debt service consumed a critical portion of its tax revenues. From ancient empires to modern industrial states, the pattern remains strikingly consistent. When debt payments eclipse fundamental public investments, governments face three painful choices: enforce extreme austerity by cutting essential public programs, raise taxes to historical highs, or print money to inflate the debt away. As we break down these complex macroeconomic chess moves, hit that subscribe button to stay informed on the critical economic stories defining our generation. Yet the most dangerous element of this crisis is that it operates beneath the surface of daily news cycles. Unlike a sudden stock market crash or a visible banking panic, structural debt expansion is a slow-motion transformation. Governments use financial repression, keeping interest rates artificially below the rate of inflation, to quietly devalue debt over time. While this strategy reduces the real burden of government debt, it effectively penalizes savers, erodes retirement accounts, and pushes ordinary investors into higher-risk assets just to preserve their wealth. It is a subtle redistribution of financial risk from the state onto the public. This combination of rising interest obligations, entitlement commitments, and shifting global trade dynamics creates an unprecedented economic challenge. Reversing this trajectory requires political sacrifice and long-term planning in a political system designed for short-term election cycles. Cutting spending threatens economic growth in the short term, while raising taxes risks slowing down private enterprise. Meanwhile, international competitors are actively building alternative trade clearance systems and regional currencies to bypass the global reserve system altogether, reducing international demand for national debt. At the exact moment, more of it must be issued. What makes this financial threshold so critical is that the global economy has never been more interconnected. The stability of mortgage markets in Texas, pension funds in London, and supply chains in Asia all depend on the stability of the global reserve currency. The real question facing us today is not whether debt matters, but how long a global economic system can rely on unlimited expansion before reality forces a structural reset. As we move deeper into this uncharted economic territory, understanding these hidden mechanisms is no longer optional. It is essential for protecting your financial future. If you want to keep exploring the deep economic and geopolitical forces that shape our world, consider subscribing today and join the conversation in the comments below.